You've got $100,000, and instead of letting it sit in a bank earning pennies, you question what's the best way to invest it without spending hours staring at stock charts, and put it to work. But not just anywhere. You're eyeing 5 powerhouse Fidelity index funds. Now, what if I told you that this decision could take that $100,000 and turn it into something truly extraordinary? I'm not talking about small gains. I'm talking millions. In this video, I'll show you and John the 5 best Fidelity index funds to invest $100,000. I'll also show you how much it can return over 10 years and 20 years. I'll show you funds that pay over $25,000 in monthly dividends. And in the end, I'll show you a Fidelity fund that has the potential to turn a $100,000 investment into a portfolio valued at over $20 million. When it comes to choosing the right index funds, it's not just about picking the biggest names or the highest returns, there's a strategy behind it. The 5 Fidelity index funds I'm showing you today are carefully selected based on a few key criteria: growth potential, dividend yield, sector performance, and long-term stability. Coming up are the top 5 Fidelity index funds ranked from good to absolute best for their potential to add serious value to your portfolio. Starting at number 5, we have the Fidelity MSCI Consumer Staples Index ETF with the ticker symbol FSTA. This is a fund that lets you invest in the essentials, the backbone of the economy. This index fund is heavily weighted toward consumer defensive stocks, meaning it includes companies that provide goods and services people can't live without, no matter the state of the economy. FSTA's top holdings read like a who's who of consumer staples. Procter & Gamble, Costco, Walmart, and Coca-Cola dominate the list, making up over 63% of the fund. These companies have a strong brand recognition, solid global operations, and a proven track record of weathering economic downturns. The fund focuses entirely on consumer defensive stocks, with over 98% of its assets in this sector. FSTA is a reliable income generator with a current dividend yield of 2.39%. Its 10-year dividend CAGR of 10.7% is even more impressive, showing that it's been consistently increasing its dividend payouts over the long term. With a record of 10 consecutive years of dividend payments and 7 years of growth, FSTA is a solid choice for balancing income with capital preservation. For example, during the 2008 financial crisis, consumer staples fell by only 15%, while the S&P 500 dropped by over 38%. This stability, combined with steady growth, makes FSTA a compelling choice for conservative investors like John who value both safety and long-term results. Let's talk about what happens if John invests $100,000 in FSTA. Historically, FSTA has delivered an average annual return of 6.41%, reflecting its focus on staple essential goods. After 1 year, John's investment could grow to approximately $108,800. Fast forward 10 years, and his investment might reach around $243,730. If he holds on for 20 years, the value could rise to about $681,853. And after 30 years, John could see his investment balloon to $2,344,387. Not only that, but the annual dividends by year 30 could provide John with an income of $165,461, or about $13,788 per month. Over these 30 years, the total value added to John's portfolio would be approximately $2,244,387 from capital appreciation and $1,097,419 from dividend reinvestments. At number 4, I have the Fidelity MSCI Consumer Discretionary Index ETF, ticker symbol FDIS. Unlike consumer staples, the consumer discretionary sector includes companies whose products and services are considered non-essential, like luxury goods, entertainment, and leisure activities. FDIS is all about growth and innovation, capturing the dynamic consumer discretionary sector. This fund invests in companies that thrive when consumers have disposable income to spend on non-essential goods and services. It's the perfect fund for those looking to tap into the spending habits of a booming economy. FDIS is heavily weighted towards industry leaders like Amazon, Tesla, and Home Depot, with these three alone comprising almost 39% of the fund. The fund's allocation to consumer cyclical stocks makes up 96% of its holdings, meaning it's highly leveraged to sectors that can experience explosive growth when the economy is strong. Although FDIS isn't primarily an income-focused fund, with a dividend yield of just 0.76%, it compensates with solid growth. The fund has an impressive 10-year dividend CAGR of 11.22%, showing that it's steadily increasing its payouts, even if the initial yield is modest. With a history of 10 consecutive years of dividend payments, FDIS still offers a growing income stream for long-term investors. Just like they did during the 2010 to 2020 period, the sector returned an average of 16% per year, compared to the S&P 500's 13%. Now, let's see what happens if John puts $100,000 into FDIS. After 1 year, John's investment could grow to about $112,190. In 10 years, this could swell to approximately $315,693. If John holds on to this fund for 20 years, his investment might grow to around $995,230. And after 30 years, it could explode to $3,133,203. By then, John could be earning nearly $20,000 in annual dividends, translating to around $1,665 per month. Over 30 years, the total value added to John's portfolio could be approximately $3,033,203 from capital appreciation and $181,172 from dividend reinvestments. The sector's sensitivity to economic growth makes it a powerful engine for long-term wealth accumulation, perfect for an investor like John looking to capitalize on economic booms. Now, if you think those returns are impressive, just wait. At the end, I'll show you a Fidelity fund that has the potential to reach that valuation in just 20 years and has the potential to exceed $20 million in valuation over the long run. Next up, at number 3, is the Fidelity MSCI Healthcare Index ETF, ticker symbol FHLC. This fund covers the healthcare sector that always stays in style with consistent demand regardless of economic cycles. This stability is desirable to investors looking for a mix of security and growth. The sector's performance during downturns such as the 2008 crisis, when it declined by only 22% compared to the S&P 500's 38% drop, underscores its defensive nature. FHLC is dominated by heavyweights like Eli Lilly, United Health Group, and Johnson & Johnson, with these top 3 holdings making up over 25% of the fund. Almost 100% of FHLC's assets are invested in healthcare stocks, making it a pure play on the sector. This concentration in healthcare offers stability, especially during uncertain economic times when demand for healthcare services remains steady. FHLC offers a modest dividend yield of 1.26%, but what sets it apart is its impressive 10-year CAGR of 16.18%, showing that dividend payouts have been snowballing, which is crucial for income-focused investors. With 10 years of consecutive dividend payments, this fund has a strong track record of rewarding its investors. If John invests $100,000 in FHLC, here's what he might expect from an average annual return of 9.24%. After 1 year, John's investment could be worth $110,500. In 10 years, it could grow to about $283,315. 20 years in, John might see his investment reach around $931,021. After 30 years, it could skyrocket to $4,063,315. By then, John could receive annual dividends of $303,540, or about $25,295 per month. The total value added to John's portfolio over 30 years could be $3,963,315 from capital appreciation and $1,581,019 from dividend reinvestments. Taking the second spot, I have the Fidelity NASDAQ Composite Index ETF, ticker symbol ONEQ. Now, if you're looking to ride the wave of technological innovation and market disruption, ONEQ is the fund for you. This ETF tracks the NASDAQ Composite Index, which includes some of the world's most innovative and fastest growing companies. It's a bet on the future, focusing heavily on tech and growth-oriented stocks. This index has historically outperformed many other indices, especially during technological advancement. For example, from 2010 to 2020, the NASDAQ returned an average of 17.5% per year, well above the S&P 500. So if John decides to invest $100,000 in ONEQ, this fund isn't a big dividend payer with a yield of just 0.64%. But it's been steadily increasing its payouts with a 10-year dividend CAGR of 7.35%. It's also delivered an impressive average annual return of 14.44%, driven by its focus on technology and growth-oriented companies. After 1 year, John's investment could grow to around $115,080. 10 years later, his investment might be worth approximately $401,400. If John holds on for 20 years, the value could rise to about $1,577,234. And after 30 years, his investment could reach a staggering $6,134,377. By then, John could be earning around $4,063 in annual dividends. Over 30 years, the total value added to John's portfolio could be approximately $6,034,377 from capital appreciation and $56,635 from dividend reinvestments. ONEQ is heavily weighted towards tech giants like Apple, Nvidia, and Microsoft, which includes nearly 40% of the fund. Technology accounts for over half of the fund's assets, with other significant allocations to communication services and consumer cyclical sectors. This gives investors exposure to industries that are driving the modern economy. And finally, at number 1, we have the Fidelity MSCI Information Technology Index ETF, ticker symbol FTEC. FTEC is the ultimate choice for tech enthusiasts. This fund gives you concentrated exposure to the information technology sector, investing in the companies that are shaping the future. If you believe in the transformative power of technology and its ability to drive market growth, then FTEC is the perfect choice for you. FTEC's top holdings include the tech titans Apple, Microsoft, and Nvidia, which together make up nearly 50% of the fund. With 99.42% of its assets invested in technology stocks, this fund is all about capturing the explosive growth potential of the tech industry. From software and semiconductors to cloud computing and AI, FTEC covers the entire tech spectrum. While FTEC's current dividend yield is a modest 0.66%, its 10-year dividend CAGR is an impressive 19.08%. This rapid growth in dividend payouts indicates that the companies within this fund are reinvesting for growth and returning value to shareholders. For long-term investors, this means a growing income stream alongside capital gains. If John invests $100,000 in FTEC, the potential returns are remarkable because of its CAGR, an average annual return of 18.67%. After 1 year, John's investment could grow to $119,330. In 10 years, his investment might reach around $586,063. If he stays invested for 20 years, the value could rise to about $3,442,790. And after 30 years, John's investment could skyrocket to an incredible $20,274,062. By the end of that period, John could be earning annual dividends of $126,172, or about $10,514 per month. The total value added to John's portfolio over 30 years could be $20,174,062 from capital appreciation and $757,359 from dividend reinvestments. Want to achieve a comfortable monthly retirement income but don't have $100,000? Click the video on the screen to explore REITs that can get the same results with just $10,000.